for our consistent delivery. As regards reinsurance partners, no changes in the reinsurance partners, and it has been consistent. And we are also glad to report that in a market where constriction of capacities happened, the reinsurers reposed faith in us. And last year we got some increases as far as more capacities are concerned, though we are using it very judiciously considering the trends in the market. You're aware that the accounting standard implementation of IFRS 17 was embarked upon, and in 2023, all our results had to be redrawn, and insurance companies are to report the results based on IFRS 17 standards. Just to give a quick heads up on major advantages and disadvantages, these IFRS 17 numbers, which we will talk about subsequently, is all not only for 31st December 23, but the recasted 31st December 2022 results also. As far as IFRS 17 is concerned, it gives you a better picture on the profitability of the insurance business, because the administrative expenses earlier, which were allocated as a complete management expenses head, gets translated into the respective lines of business. Second advantage of the IFRS 17 reporting is the interest cost has to get accounted for, because the trends on the rate of interest keeps changing, and this requires to get reflected in your discountings. As far as the disadvantage of IFRS 17 is concerned, it is a fairly complex piece still to settle down, and there are a lot of challenges which we also faced on various interpretations, engaging with actuaries, auditors, and finally coming to some conclusions on how to finalize our financial results. It requires a lot of effort with regard to actuarial inputs and validating the models. So I think the challenge which we all face is to get the reportings done within the next 15 days of the end of the quarter going forward. So while this is there, but this is the standard to settle down now as far as insurance companies are concerned. Next, coming to IFRS 9, this went in conjunction with the IFRS 17 reporting. And mainly, if you see, it is more objective as far as the data provisions are concerned. Certain investments have changes in fair value as taken directly to equity, and income statement will not be exposed to the volatilities of the variations in the values. The disadvantage is obviously initially data provisions would be higher, because it will even require you to provide for long-term bank deposits also to have some credit loss provisions to be incorporated. So with these challenges, we embarked on the IFRS 17 and 9 incorporations and finalizing our results for 31st December 23. If you see, mainly, it is not like the earlier ones. It is a deeper one, which is giving you an idea of the insurance companies' results on the business, their own core business, as well as the investment business, which is there as part of our results. So overall, on the insurance revenue side, we were at 32.8 million. This is net of the RI, and 31 as against 32.06 of last year, which is a 2.39% growth over last year. This has to be seen in the backdrop of the fact that the market has been seeing a fair amount of downward price movements, and post Shaheen, certain corrections were there as far as the pricing is concerned. But this did pose a lot of challenges with regard to the development of loss ratios, requiring corrective actions, and we started taking actions effective September onwards. So you will see that the insurance revenue piece is more or less stable with a growth of about 3.3%. But the composition of the insurance revenue has undergone a change. We have a very good mix. Now we ended the year with about a 45% on non-motor, 45% on motor, and we have a 10% on medical and life. So it's a very good mix to have, which can actually help you stabilize the results in case there are any sudden kind of variation which we observe. On the insurance service result, we had 726,000 riyals as the service result, as against 250,000 last year. So overall 475,000 up, which is 190%. This parameter is very important because I think in this market, it is not GPW and it is this result which will help us to hold. The investment service result, 3.1 million against 3.6 million. We will come more on this particular item subsequently. But overall, if you see profit before tax was 2.8 million against 2.6 million, which is a 5.7% growth. And total comprehensive income was 1.7 against 2.3 million, which is a 23% downward revenue. Anything you'd like to supplement? Okay, primarily on the key indicators on the results based on IFRS 17. If you observe for Oman United, insurance revenue, which is the earned premium to net of credit losses, it has been stable for 2023 compared to 22. Insurance service result was 190% up. Insurance service ratio was 2%, which is a fairly good piece because it gives an indication of our methodology of on IBNR and provisioning. It has been consistent. And profit after tax is also 2.8 million overall against 2.65. 2.65 against 2.4. As a summary, as far as financial results of OUIC is concerned, as on 31st December, our total asset size was 92 million against 103 million last year. But this has to be seen in the backdrop that there was a almost 9.5 to 10 million kind of reduction in the overall insurance liabilities also. So that is why it is an equal matching on the asset side also. Paid up capital 10 million, shareholders equity as 28.26. Total investment of 61.92, of which 73% is in deposits. There was a change of strategy last year, and this mix has undergone a slight change, but more or less you would observe that the total investment component on equity plus the other fixed investments which we had was in the range of about 60 million. So not much of a change on the overall corpus. Against this, you have to see in the backdrop that there was a 3.5 million outgo on the dividend also for last year. As regards solvency surplus, our current solvency surplus is 17.7 million calculated as per CMA guidelines against 9.2 million, which was required to be maintained. So we are fairly well above the requirements of solvency. We have an additional contingency reserve of 10 million, and our reinsurance treaty leaders as well as supporting partners remain more or less the same. All are rated, and we have not had any instance of any delays in the claim settlements, etc. It has been fairly quick, and we've been able to meet our requirements to the insured people at large. Yeah. This is a summary of the financial position as on 31/12/23. As I explained, 92 million is our balance sheet size, asset size, against 103 million last year. If you observe on the deposit side, on the asset side, deposits along with the financial assets, broadly in the range of 59 to 60 million, which was also the number plus or minus a million of last year. More or less consistent on the investment side. As far as the insurance contract liabilities item, if you can see, last year there was a 62.5 million. Against that, we ended the current year with 53.3, which is because there were certain change of reserves in the primarily some big claims which came down. Shareholders' equity, I think against last year's 29.9, 30 million, we are at 28.2 million. This is with the backdrop of a 3.5 million outgo on dividends. More or less all the major reserves are consistent. The fair value reserve has come down from 2.1 to 1.9. There is an insurance finance reserve, basically the other comprehensive income item, which is the treatment based on IFRS 17. So this will change on a quarter by quarter basis. Next. Yeah, composition and strategy of investments. Fixed income investments is about 44.8 against 52.5 last year. Equity investments 14.9, almost 15 million against 8.5 last year. And immovable properties, we have two assets, which is our, we have an automobile garage in Gala, as well as the main Oman United building, which is here in Muscat, in Alquer. So they were at, last year was at 2 million, this year is at 1.9 net of depreciation. But as far as fixed income investments are concerned, this is net of accrued interest income and provisions. So we will continue our strategy of cautious investment. You can see this, that the MSX was not very, end of the year, the results were not as good. So we were able to maintain the results in spite of the investments. So the one change which has happened, I think more or less on these two properties we have already stated, there is an unrecognized appreciation of almost 4 million plus. And but on the garage property in Gala, we have partly leased it out effective 1st of January 2024, which is an automobile garage to an automobile garage, which will yield us an income of about 180,000 riyals for the year. This also has to be seen in the light of the fact that there was some realignment of headcount as a result of the release of the resources who were part of the garage as part of the Oman United employees. We take pride as an Omani company. We have been there. We have fairly strong Omanization guidelines internally. We are currently at 85%. We have 203 total strength, and about 170 people underwent various forms of training, workshops, and seminars within the last year. So there has been a fair amount of investment on training, retraining our people, and we will hope to continue this going forward also. We have seen some very good results as a result of these investments. Hopefully in the next 2 years, we will be coming full cycle on this. Strength of the company, a very strong balance sheet with a good retained earnings of 7 million. We had our challenges, but IFRS 17 implementation was on track, and we successfully completed it within the timeline given by the regulators. And our reserving methodology is overseen by two actuaries separately for the life and medical division and the general division. The results have been consistent, and that is reflected in one of the ratios which I talked about earlier. So as far as challenges for the company for the year ahead, we are doing some, price remains a big challenge as far as the market is concerned, but we are seeing corrections. We have done some corrections September onwards. We are seeing positive trends as far as market uptake on the price is concerned. The portfolio composition, as I told you, underwent a change last year as a result of certain actions taken by us. And about 45% of our book is non-motor and 45% of the book is motor. So non-motor ended up last year with the highest underwriting profit. So to some extent, it overcame the challenges of the motor line of business. Medical business also continues to be seeing low pricing, but we are very cautious as far as this line of business is concerned, as there is a challenge with regard to collection of premiums, endorsement premiums to be collected, as well as seeing a complete net approach in the market, which does not fly with us as a strategy. So we would like to participate in the risk. We would like to control it as far as engaging on the loss risks are concerned, and we would like to pay in time. That's our philosophy, and we are seeing some challenge on the medical business, but we are a little careful on this line of business. As far as future outlook, I think we will expand equity investments. We are very positive on the various steps taken and what we are witnessing in Oman and outside of Oman. But we hope it will give a fillip to more kind of business in the current year, 2024, and that will also help us to engage in equity investment, which can give us higher yields. We are focusing on non-motor business growth. Last year was a good year, and of course, we didn't have a catastrophic event like Shaheen, but glad to report as far as Shaheen is concerned, while our initial estimates were in the range of 4.1 million, we finally ended up in the range of about 2.6 million. So, and overall exposure to the company was minimal, and we were able to recover maximum from the reinsurers. So we are ready as far as mandatory health insurance is concerned, but we'll have to wait and watch for the spirit as to how the regulator views it and when it comes through. And we are investing in the digital marketing space, and we would like to reduce the distribution cost as far as throwing up the retail lines of or retail products to the public at large. Thank you very much. Any questions, please?
Hello.
Yes.
Hi, good afternoon. This is Bishan Bhala from Vision Capital. Thank you for the presentation for this call. I had a couple of queries. First is, we understand there's been a change in the reporting format to implement IFRS 17. It would be helpful if you could sort of give us, if not now, in the subsequent announcements and calls, some sort of comparison to the earlier reporting, because that would be an easier way for us to look at the performance. So, for example, you clearly mentioned the reasons for the lackluster operating performance in the sector, and I've seen that number for OUIC, but it would be interesting to sort of look at the key drivers, because we break down the operating performance from a loss ratio, expense ratio, and a commission ratio perspective. And I'm not able to do that analysis right now because I don't have a net written premium number, as was the case earlier on. It would be helpful to at least get those numbers, as well as I saw information with regards to individual loss ratios for the segments missing, which was there in your earlier notes. So if you could just talk about loss ratio across the different segments.
Actually, yeah, point taken. I think we will probably include a IFRS 4 slide for the subsequent presentations. But overall, considering what has been seen, motor loss ratios were high. They were at almost, we used to be at about 114, 115, but we brought it down and we did some segmentation and we have done some corrective actions, and we ended the year at about 98. And fleet business continues to be profitable. All lines, none of the lines required a premium deficiency reserve. So that will give you an indication of where they will be on the product lines first.
Okay. Now, if I look at your
on non-motor lines of business, we had the highest kind of profitability. We had returned close to 2.25 million for the year, which was the highest in the last almost 15 years of our operations. So the change in the retention strategy, putting the insurance program differently effective July, all that actually helped us to overcome this challenge on the motor and the non-motor growth. And overall, there is not much of an exposure as far as company is concerned. We have been consistent in our underwriting approach, and it has been valued by the reinsurers also. So we returned against 1.6, 1.7, almost a 2.2 million. That kind of range we used to operate earlier.
And in terms of sort of a retention ratio or a let's say the earlier reported GWP and a sort of reinsured number, how do we sort of break that down? So if I were to look at a GWP and then sort of see what piece of the business you're writing and what you're retaining and what you're reinsuring versus what the net written premium is, how do we sort of arrive at that?
Yeah, from the IFRS 17 numbers, I don't think you'll be able to arrive at that. But broadly, our retention ratios were in the range of about 46% for the year.
Okay.
More comparable to about 47.5 last year.
Okay. It would actually be helpful if going forward you could sort of just give us some guidance that way, unless that whole model has completely changed. Because we were on a call yesterday with another insurance company, And we highlighted the same point, and they sort of took it, and they said they would try and work on that going forward, because that would help us to at least in the meanwhile get a better grip of how the earlier reporting used to be. Because currently the way I look at operating profit is I look at your profit before tax and I net out your investment income, and that's how I arrive at operating profit. But I don't have the key drivers per se, you know. So I only see a other operating expense over there, which is your G&A, I would imagine. But beyond that, I do not see the other segments. That becomes a bit of a challenge to at least analyze how the company is doing across the sector and you know, compared to historic periods as well. That's sort of one comment from my side. Apart from that, we saw your other operating expenses decline from 1.9 million to 1.5 million. If you could just comment on that.
That is the traditional holdings, no?
It's other management to the bonus.
I have not had that figure.
No, there are some, yes, some expenses have been reduced, like staff expenses and bonus and others, you know, because of the performance. So that is why, and garage expenses also got reduced. So that is why, you know, you are seeing some drop in the expenses.
Okay, all right. Noted. And with regards to, you know, if I look at the segmental information published in your notes, medical segment is one where, even though it's a very, very small segment, it's been a loss-making segment at gross level also for the company for both 2022 and 2023. Your insurance service results were negative in both the years. So, what's the strategy over there? Is that sort of just purely for servicing basis, or would you look to sort of reduce that exposure?
See, medical, we will continue to be very cautious because, you know, there is not much of margin. Okay. So our medical portfolio is about $2.2 million for 2023. And we will be very careful in writing the medical business as usual. You know, that is our board strategy, that we wanted to go with quality of business, not quantity of business. That is our philosophy from, you know, from the beginning of the company. That is why, you know, we are very careful in writing this type of lower margin businesses.
Noted. And in terms of how the premiums have shaped up over the last couple of years, how do you see that evolving? I mean, there was intense price competition historically over the last couple of years. Have you seen that trend slightly improving over the last 6 odd months, or do you still think it's extremely competitive on the motor side as well as on the other lines?
Yes, in the motor side, you know, it's I'm sure that all the insurance companies are having, you know, a difficult time. And gradually it has to get increased. In fact, we did some price correction in last September. And again, it's an ongoing process and we'll be keep on changing it. And I'm sure that other companies also will be keep, changing the rates. So because everybody has to maintain the solvency margin and then, cash flow also they have to see. And I'm sure that everybody has to adjust it.
Noted. No, point well noted. Historically, the Point United has been one of the best performing companies, both on the operating side as well as on the investment book. And you continue to do a fantastic job on the investment book. Now, historically, if I look at your combined ratio, it was around the 85, sub 90% mark. And last couple of years, it's been obviously, it's been more than 100%. Now, what's the strategy or time frame that you have in mind to sort of return back to operational profitability?
You cannot improve it very significantly, but this will be the range between 85 to 95. That should be our combined ratio, because we cannot improve it. Also, then we won't be able to be competitive in the market. So the range will be, the combined ratio will be between 85 to 95. That is our wish.
No, that would be a fantastic number, but currently we're seeing upwards of 100%. Do you see it reverting back to, let's say, the 90 or even 95% levels in FY24?
See, we have done some price correction in September, as I said. Now it's 6 months are over. And again, we are likely to look into that price correction. And we are expecting that, things have to improve very, it has to improve in 24, but we won't be able to tell you what will be the percentage of, increase.
Okay, and if I go
That's
look at combined ratio, then 2022, your combined ratio was 108%, which was a operating loss of 1.66 million. In 2023, the operating loss has reduced to 808,000 riyals. So what combined ratio is that? 103%, 104%? At least for FY23 that's gone by?
Yes, what is your question, please?
I'll repeat my question. So in FY20, in 2022, the operating loss was 1.66 million as per your latest release financial, which gives me a combined ratio of 108%. In 2023, the operating profit is, or it's an operating loss of 808,000 riyals. What combined ratio would that sort of, if you give me a combined ratio for Q4 and for 23, the year that's gone by, at least that would give me an idea of what's the current run rate the company is at.
102. I think it's 102. That's what, 102 is the combined ratio, right? So,
Right. So that's the current landscape where you are. You've taken some steps to try and improve that number going forward, and the endeavor would be eventually to revert back to your 90-95% historic operating profit number. Is that
right,
a correct statement? Okay.
Yeah, that is a correct statement.
Great. Okay. Thank you, Mr. Muthu and team. Wish you all the best.
Thank you. Thank you. Yes. From anybody else?
Any other questions, please?
Thank you. Mr. Abbas, Mr. Joyce, anybody else?
Yes, thank you.
Hi, good afternoon, gentlemen. This is Abbas. Thank you very much for the call. Thank you for the presentation as well. It's been a bit of a learning curve for all of us, just to get used to this IFRS 17 standard. So thank you for taking us through it. I think you mentioned in the outlook that the idea is to increase equity exposure, and you've been obviously done a fantastic job with your equity exposure, even in a year like last year when the markets went down. So kudos to the entire team who's managing the equity book. So my question is, if you look at an overall book, currently equity sits around 25% of your overall investment book. Where do you see this going up to this number?
We are looking at other GCC. No, we're looking at the GCC market. On the local market, I could say the liquidity is not much compared to the other GCC markets. So we are trying to explore into the GCC markets. Whatever within the investment regulations.
Correct. Right. Because I know they treat funds differently than direct investment, especially when it comes to taxes as well. So now tell me, in terms of exposure, your book is around 14 million riyal in equity. Do you have like a number in mind, or do you have a percentage in mind where you can take this number to?
Yeah, the local market, maybe we can take it up maybe another 2 to 3 million riyals. And then rest is something. The rest is maybe another $3 million can go into the GCC markets. That we have to wait and see, not immediately within the next quarter, and it has to be done in a gradual manner.
Sure. Okay. And what's your current average yield on your deposits right now?
It's about 5.8, 4.8 to 5.2. I think that is it.
So the average will be closer to 5% on your investment book of 45 million. So that's around 22.2, 2.3 million money there. And then you have an equity book of 15, and you have an equity book of 15 million. And obviously that has a certain dividend yield and certain growth attached to it. So that depends on the market. So basically, when it comes down to the operating side, you've commented that there was some segmentation that allowed you to become, at least cut your losses on the motor side. And, you've done a great job. I can see the changes in numbers when you look at it on an operating profitability basis. So the number for us to watch is obviously that if I exclude your investment income, can you break even on the operating level, which you were not able to do last year, but you managed to do better than 2022. And from what you're telling us is, when you give us the guidance of 90% combined ratio, which I think is a fantastic number, that means you will break not just break even on the operation level, you'll be profitable in operating level. But does that fit into what's happening in the country right now? Because it's a very competitive market. So when you have such an aggressive target, which segments are you looking at to actually increase this, right? So I mean, I take your number and I see that it's a huge improvement if it happens. But how are you going to segment in a market where everyone is pretty much writing and retaining motor, and everything else is a pass-through, and medical business has been loss-making for a while right now? So what's going to be the actual strategy to make this happen?
See, it will be in the motor portfolio. We have to be very selective in the retail business. And then, we have to see, we have a good network of, branches and agents and direct marketing and brokers. So we have to tell them their underwriting guidelines and make sure that, they are following their underwriting guidelines. That's it. And
but
then
this
price
has been the case for many years, right? Yes.
No,
okay. Yes.
Now we are a little more focused actually. We are looking at, in more in detail, and we are asking them to be more, we are not giving them more flexibilities to them, our, retail networks and all that.
So I will just. I'll just add a comment to what Muthu said. See, it's not only a question of looking at what you write on our top line on the premium side. There is a corresponding effect of any kind of action which you take. There could be a corresponding effect on cost savings with regard to whatever is the reinsurance outgo, as well as the cost of people whom we put on or the commissions, all these three. So I think a combination of these will also draw down the costs a little bit.
Okay, but has there been any concerted effort where the insurance companies are speaking to each other and saying that let's raise rates, or let's put a floor on rates? Let's not be so let's not hurt each other when it comes to premium. Is that a conversation in the market, or that's not going to be possible? Because I'm hearing the same sentiment from other insurance companies, but I'm just thinking, it's very difficult to raise rates in any market, right? Especially a market like Oman, where obviously, it's a rather cost-conscious market. So I'm just wondering what I'm just trying to see if there's an uptick in rates, or what's going on. What am I missing?
No, naturally, see, all the shareholders, and all the company managements, they have to look into this, return to the shareholders, number one. Number two, they have to look at the solvency margin and the cash flow issue also. Okay, so that being the case, naturally, they have to increase it. There is no such agreement among the insurance companies. Okay, everyone has the freedom to increase or reduce the rate according to the management wish. There is no such agreement between the companies. It's everyone is independent, and everyone has to look at their own balance sheet. That's it.
Okay, so you're saying the shareholder return should ideally drive that makes a lot of sense to me. So yes. Okay, fair enough. Yeah, right. That makes sense.
It is not like any other insurance. Insurance business is a tricky business. We are underwriting the risk, not like any other business. Okay, you have fixed cost, and then whatever income that you generate, straight away it comes. At least you are making some money. But right. Insurance is not like that. We are underwriting the risk, and we have to be very selective in underwriting. That's it.
Right.
So beyond that, if the comes,
right.
Yeah, that's it.
So all these policies that you've spoken about, we've started seeing the changes, and that changes we should start seeing that from the first quarter onwards, right? I mean, it's not like you've sort of turned the ship and it's going to take a while to sort of get there. We're already going to see the benefit of all the changes you made from the first quarter on an operating level from the first quarter performance itself, right?
No, it's not like, yes, you are right. But at the same time, whatever policies which we have written in the previous year, last year, until it expires, you have your liability, okay? So that may be a concern also for us, So it will take
reflected in first quarter.
So it won't get reflected, 100% or even 60% don't get reflected in the first quarter, but it's gradually it has to improve. If it is improvement, it will be gradual improvement.
Got it. Understood. And you spoke about the hidden equity you're sitting on the real estate properties, both in the garage, but there's no plan to exit these things. But you've not obviously it's not reflecting in your equity.
No. It is these are all lifetime investments, and there is no intention of selling out any of these assets. And in fact, recently we have given out the garage for leasing from 1st of January.
Right.
We are getting about 180,000. They also fixed the rental income. That is the additional income that we are getting it now. Because we looked at the pros and cons of operating the garage, then we found that leasing is a better option. So board has approved it, and from 1st January we went into agreement with some third party, and then they have taken it for lease.
Okay, but there is no way accounting wise you can reflect the fair value in your equity, right? Because OUIC, I've noticed that you've been paying more than 100% payout ratio over the last couple of years. So I'm just wondering, this could further sort of help you in terms of retained earnings, right? Give you that support, but there's no real way for you to just book the gains there's no way to do that unless you sell it.
No. We are not that. We don't want to just inflate the balance sheet like this. Okay, unless you realize it, we don't want to bring it to the balance sheet.
Okay.
We don't want to inflate it, and then that is our philosophy from the beginning.
Right.
Yes.
Okay.
That is that we do. Okay.
Okay. Thank you for your answers and all the very best to you. Thank you.
Thank you.
Thank you.
So much. Bye.
Thank you.
Please close. From anybody else, any questions?
Any other questions, please?
One raised hand. That's for the from the beginning.
That's from the beginning.
So can we close the session? Thank you. Thank you. Vote of thanks.
Thank you very much for everybody and for your questions. We hope we have done our job, and everybody, inshallah, enjoy your Ramadan and prayers for everybody. Thank you very much.
Thank you so
Thank
much.
you.
Thank you
very much.
Thank you all.
Meeting. Not giving a guide, so
Thank you very much.
Thank you.
Thank you.
Take it over the task.
You take it or
Thank you. Thank you.
كلام تسعود. هو كلام.
Last gets allocated directly. It is not an apples to apples. Better? Can you go?
Yes.
Yes, sir. Thank you so much, Musa, for the arrangement of yesterday and today. Everything went very nicely.
I noted it all.